Hey, good morning. This is Chris Robinson, Robinson Marketing with today's morning grain comment. Usually I do a pre-opening, but a little bit of a busy morning here, so I'm getting after it here. It's 10:26 a.m. One thing I'm noticing, starting to hear some, different stories from different clients coming in that, maybe the yield's not there, maybe rust was worth worse than it was. Um, I don't know. Well, the proof's going to be in the pudding, but with the government shutdown and everything, it may be a while before we really know what exactly was going on with these yields in the corn. And at the end of the day, we've been chewing on the fact that this is going to be a supposedly the biggest crop ever we've grown, over 16 billion bushels of corn. Um, I would say this, can we get a bounce? Yeah. Are we at a key technical spot here right now? Yeah. March corn, especially. I'm looking at March corn. We had the rally up from the August contract lows. We traded 410, went from 410 to just barely under 450. 449 was the high. So we had a 39-cent rally. Don't look right now, but we're sitting halfway back. And we did come down and with that low yesterday, that 25 and a half area, that was roughly a 62% pullback. So, for everybody's got a different perspective about what they want to do with their marketing. I look at it these technicals do matter. Not surprising that we found support there at 425. That's the 62% retracement of the last little move. So can you trade these little ranges? I don't know if you want to or not, but this is a key level. This 430 level, 429 and a half level where we're sitting at right now. Why is it key? Well, because everybody since the August low, you're bullish or bearish. You're right in the middle. You're equally right, equally wrong. So this is a reset opportunity for everybody that's got corn risk out there. If you have a firm belief that the yields aren't there, this might be an area to look at. Number one, certainly rolling down any put options you have on defending lower prices, right? Number two, extending your protection out and trying to keep as cheap as possible, because what you don't want to do is get hung out to dry with no protection, and then you were wrong. The yields are there, and then we're sub, $4 in March corn, and you're scratching your head, going, "Wow, but I thought this, but I thought that." Doesn't matter what you think. Well, we're here to manage risk, and that's why today is so important, because this level here, this 429 and a half level in March corn, it's the halfway back level. So it's a key level. It's a key reset button. Whatever your bias is, you need to readdress your risk management. So if you're storing it, keep a floor, but make it cheap, 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 cheap. If you're an end user and you're worried that, yeah, the yields aren't there, and boy, it's going to be more expensive for me after the first year to buy corn, and I won't like that. Well, you can buy some very, very cheap calls right now for the next 70 days and put yourself in a situation where if we do rally, if the all the bears are wrong and they get their face ripped off with a rally, well, if you've got your call on before the rally, then you'll make money. So there's no guarantees out there, but you do have to set the trap. And this is one of those situations where everybody gets to put their money where your mouth is. But I would say this: if I'm a business person and I've got thousands and thousands of bushels that are unpriced, I'm more concerned about what happens if corn goes, drops 30 cents than if it rallies 30 cents. I want to protect against those contract lows again, fighting tooth and nail. So that's my big thought for the day. That would extend really for anything, beans as well. It's nice to see soybeans holding above $10 despite all the daily battles back and forth with the tariff talks, right? So $10 gives everybody, again, it's an excuse to reassess your risk. I would maintain a floor. Why? Because if I'm long a bunch of beans, I don't want to be sitting looking where we were back on December of 2024, at 961. I don't want to be back where we were in August, or excuse me, in April at 971. I don't want to be where we were in August at 981. So I don't want to be in a situation where I've given up that revenue. So defend, 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 keep the upside open. And if you're looking for hedges that might work for you now with these shorter dated options, there's a lot of strategies we can do that might make sense to your bottom line. Doesn't matter if you've got a small operation or a big operation, you have economic risk. And these hedges, if we use them judiciously, uh, they can help your bottom line, or they can at least help you hold on so that we can do what we all want to do, which is get paid at the elevator, get paid at the ethanol plant. I want you to make better cash sales. This is Chris Robinson, 312-638-8868. Oh, real quick before I go, the cattle market just keeps on trudging higher and higher and higher. We've got a little bit of volatility this morning. We're down about $1.30. I would say November's, if we take out 79 or 78, you may get a little bit of downside pressure there. Again, a lot of guys are out there trying to call the tops. Well, yesterday we had our all-time contract high in November feeders at 382.80. So 382.80 is now the new must-have number for the bulls. That was yesterday's contract high in November beans. We're trading at 379.60 right now. I will say this, 10, 12 years ago, when cattle was a lot less expensive, we would spend 3 cents a hundredweight to protect cattle. So now where we're at right now, yes, these options are expensive. I had a guy call me up and tell me how expensive his LDP was. Well, yeah, if you're going out and buying 300 days worth of protection, even if it's subsidized, which is what LDP is, those subsidized puts, they're still expensive. And the flip side to those puts is, number one, you cannot trade them once you buy them. You have to hold them until they expire. So you don't get a chance to roll them or adjust them if the market moves. And you're locked in. So they do have a place in everybody's marketing program, in my opinion. Anytime you can get a subsidized revenue protection plan, I would absolutely positively take a look at it. But I think that there are some choices out there now which give you more flexibility if you're selective with how much you spend and where you get your protection on. So that's it. We'll see. The DSFAC cattle, again, same thing. We're contract highs yesterday for DSFAC cattle. That print was 246.975. Couldn't get the 247. I would say this: did we really come all this way to not get a 250 print in fat cattle? Did we really come all this way in November feeders to not get a $4 print out there sooner or later? That would be my concern here if I'm trying to call a top. Again, this is Chris Robinson, 312-638-8868. Hope you're having a good day. Give me a call if you want some help with your hedges.